Hey gang, Dennis Tubbergen here with another market update. Today is Tuesday, April 17. It's D-Day. If you haven't filed your taxes yet, today's the day. Hey, I want to analyze today the U.S. government bond market, and I'm going to analyze the long bond, the long 20-year plus. To do that, I'm going to use the exchange traded fund TLT, and I have on the screen a monthly chart. And today I want to again emphasize the importance of analyzing a market in different time frames. So we're going to look at the U.S. government bond market on a monthly basis, on a weekly basis, and on a daily basis. Now I've pre-drawn some trend lines on the chart here, and you can see that on a monthly basis, this chart goes all the way back about 15 years. And you can see that the trend over that 15-year time frame is that U.S. government bonds have been rallying, which means that interest rates have been declining. Now, to understand bonds, it's important, and many of you probably already understand this, that bonds and yields have an inverse or opposite relationship. So as bonds rally, interest rates decline. Now, you see we have a nice upward trend channel here going all the way back here to really the financial crisis, and during that time frame, bond price moves have been contained in this rather wide price trend channel. Of late, though, if we take a look at the peak here, and if I go move my cursor here, you can see that this is July of 2016. Since that time, bonds have been declining. What's telling on a monthly chart is the volume. So if you go back here and look at volumes, you can see that this upward volume is really strong. That tells you that that rally could be sustained. But now, however, when you look at the high volume levels, it's on the downside. So that could be something that could be somewhat concerning moving ahead. Now, if we go to a weekly chart, this goes back to 2011, you see that the uptrend since 2011, and again, a weekly chart, every bar in this chart represents 1 week of price action. So if you go back here to 2011, you see that this trend line has been touched really 3 times, and the 4th time it was penetrated to the downside. This is consistent with those higher volumes on the downside on a monthly chart. And a lot of times when you see this chart pattern, you see when prices break through the trend line to the downside here, when prices are uptrending, and then they rally back to that line, that's often referred to as a kiss goodbye. Often prices rally back to the trend line before continuing their decline. Now, if we look at a daily chart of this same exchange traded fund, you see that on a daily basis, going all the way back to mid-2016, there's a downtrend in place. And on a daily chart, you don't really see any signs of an uptrend. So for the last almost 2 years, bonds have been falling, which means yields have been rising. The next big point here is this support line. And the support line's not really strong. There could be a support line here. When prices break that to the downside, we can assume that U.S. government bonds are going to continue to decline and yields will continue to rise. That would be consistent with how we're analyzing the bond market fundamentally as well. If stocks happen to break down before bonds, all bets are off. But if you've been following our work for any period of time, you know that we believe the U.S. dollar, U.S. government bonds, and stocks are all in a bubble, as well as real estate. And we could see simultaneous trouble in all these markets moving ahead. That's today's market update. It's Tuesday, April 17, and I'm Dennis Tubbergen.